Today, you're going to hear a story of a Singaporean who's in a regular job, and let's call him Jay. Jay has 2 kids and he's managed to build a very interesting investment portfolio up. So if you want to learn about personal finance and if you want to learn more about investing, continue watching. Hi guys, welcome back. Let's start by sharing more details about Jay with you. Jay is in his early 40s and he has 2 young kids, earning about $6,000 a month. And right now, he's trying to save about $1,200 per month and dollar cost average in the markets. And because expenses have picked up after his second kid, he's unable to save as much as in previous years. So that reinforces again, for any young couple, before kids, this is your golden period to save. After that, of course, life priorities are different. We always want to provide the best as parents, and those expenses are fine. But the main point again is take note of your golden window to save, because as what you hear from Jay's case, life changes, correct? So right now, his expenses have stepped up and he's still trying to achieve a yearly trip with his kids because he believes that memories will last a very long time. First and foremost, I think saving $1,200 with a $6,000 salary is actually not bad. That is still like 20% of savings rate, correct? With 2 young kids some more. So I actually went to take the initiative to find a bit more from Jay. Hey Jay, is your wife also earning income? And the answer is yes, also earning similar around $6,000. That means the combined family income is about $12,000 to $13,000. That explains also the ability to save up, correct? Because if Jay is a sole breadwinner, then of course saving $1,200, feeding a family of 4, that is close to impossible in Singapore's term. So having dual income allows financial planning to be easier, allows retirement savings to be better, and also allows a bit more resources to bring up children. More importantly, Jay has no car loans. I've checked with him about it, and therefore expenses are still relatively manageable. But a part of spending on travels, that's where I also agree on. Bringing kids on trips, that's also where I form my best memories with my own children. We can go JB, Legoland will do, not too bad. There's also farms in Thailand. I brought my kids to Kanchanaburi. I brought my kids also to Khao Yai. So these are some shots whereby I've actually used the chance to teach them about Mother Nature and spend really quality time with them. Whenever I travel, I use YouTrip, my ultimate travel buddy, making overseas spending easier, smarter, and cheaper. YouTrip does not charge any FX fees. Typical bank fees can be up to 3.5%. With YouTrip, you get the best exchange rates for 150 plus countries and one of the best ways to save money while traveling. This is a quick look inside my wallet. You can see that I'm holding some Japanese yen. And do you know you can hold up to 12 currencies and up to 20,000 equivalent at any time. This is a quick look when I went for a day trip. YouTrip allows you seamless and cashless payments with full transparency. From my experience, notifications come in and you can actually track spending very easily. I've actually paid for petrol, food, massage, saving money on the many transactions I've done. And at one point, I even ran out of funds and did a quick top up via PayNow, and it was instant. And last but not least, if you're also traveling to China, YouTrip allows linkage with Alipay and WeChat Pay. So if you're looking to download YouTrip, you can actually sign up with less than 3 minutes with SingPass or submit your documents manually. Instantly top up your wallet with PayNow, like what I mentioned just now. And once you do so, you can start using your virtual card with the best exchange rates while you wait for your physical card to be delivered to you. And how about this feature if you need cash? Withdraw from international ATMs at the best rates. Free ATM withdrawals of up to $400 per month. Travel more with YouTrip today. Simply input my promo code JoshTan7 when you're signing up and you'll get a free $7. And let YouTrip help you. So let's go back to Jay's story. Right now, he's staying in a resale HDB flat and is fully serviceable by his OA account. So his OA account has a balance of $40,000 and he has no plans to use that to invest as he regards it as bond. Bravo. OA, that $40,000 is buffer, I have no problems with that. And the main part is that the OA is fully servicing his house loan, which frees up cash, correct, to invest. So if you're buying a new house right now and you want some numbers, how can that actually happen? Let me show you. If the home loan is less than $500,000, it is possible to keep it everything within OA. Husband, wife each pay $1,200 from CPF OA, and from this calculator, which can help you understand your numbers, you realize that if you budget it in such a way, you definitely can also achieve what Jay is achieving which is to push all these costs to CPF OA and allow you to have more investable cash flow. Then I also found something curious. Is this Jay's first home or not? Because he mentioned it's a resale home, correct? So Jay has actually shared that this is actually not his first house. His first house was a 4-room BTO, which he sold it off with some profits. As always, BTO is about the best place to make your first pot of gold. Not so for private properties. BTO and EC is almost a show-in from all the case studies I've seen. So with the BTO sale, that cash out, he reinvested into his new house, which is a 5-room resale. And although there was a bit of cash proceeds, it went mainly to renovation as well as a short-term rental stay. Mainly when, so maybe there was some cash that could come out from there and it helped him further build his investment portfolio. So with that, let's move on next to the investment journey that he has seen. Back in 2020, Jay started investing in Singapore banks, REITs, during the stay-at-home COVID period. He cashed out of them when he thought that he has learned enough from US stocks and moved his entire pot over there. I actually went to ask him how much did he invest as a newbie. So he's actually shared, in 2020, he plowed in his first 30,000 even as a newbie. So bravo. These are times where you make a lot of money. And all it needs is for you to understand that the world doesn't end right there, even in COVID. Investing then, however bad the economic news is really an easy time to make money. Then in 2021, he started to invest in a standard idea like IWDA, which is World ETF, as well as EIMI. But he thought that this combination, the gains were too low. So he changed next to SXLK and QQQ, which are both tech focused, but also quickly sold out from there. Towards the end of 2021, he sold the ETFs and moved towards a sniper theory and started stock picking. 2021, if you think back about it, I think that was when the markets were roaring, correct? And tech had its first big run up. Back then, there were a lot of non-profitable tech that was also doubling and tripling in prices. So it was a frenzy, and it's very natural that investors get impatient because everything seems to be going up in double digit, right? And regarding that sniper theory, I think it sounds a bit familiar. I think it's probably from Chicken Genius, who was very popular back then. If I'm not wrong, he coined that term, but just to reconfirm, that's not a formal investment term. That's just an idea of being very concentrated in stock picks and to take big swings. But as we know, sniper theory sounds very nice, correct? Because ideally, if we have identified a winner, let's go big into it, right? That's how you actually outperform the market. Take very few shots, but take very big shots. It sounds nice until we eat a few humbling pie from Mr. Market that nobody knows where the markets will be. Our biggest enemies are very frequently our own overconfidence. That's where we don't know our own blind spots, and that's where we don't know what will kill us. So being too concentrated would sound nice, but again, investing is not a race to see who's the best investor in the world. It's about growing and compounding and staying alive even with mistakes. That is truly what I believe. So back to what Jay has shared. 2022 to 2024, things were really bad. In 2022 alone, he's lost 48%. But things eventually turned green. He was doing okay with monthly options as allowance, but got burned once or twice and ended up covering his covered calls with a big loss. So again, ideas such as options trading, we only hear the nice things. Once you are inside it, you realize it's not as foolproof. Then next, he decided to focus on monthly sum investing DCA into IWY. All in all, this segment seems very brief. 3 years, I'm sure there's a lot of things that have happened. We'll come back to that. Then that fast forwards to 2025. Opinions changed again. Didn't end up going through with the ETF and went back to stock picking. I think this shows a bit of impatience. Never mind. Jay started to pick small investment pots of dividend income ETFs like JEPQ and QQQI and then into BTCI. These are income producing ETFs which use options embedded within it. So what it does is it gives up certain upside for income, but also when markets drop, these also have downside. So use them carefully. Then recently he sold his Palantir and went all in into UNH, United Health. That was his biggest realized trade right now in 2025. Moving on to Jay's questions. Jay is a bit concerned because markets are at all-time high and he's thinking of rebalancing his portfolio, namely another 50 to 75% of Palantir into Google and maybe into Nvidia. What are other options that I would suggest that he can take a look at? For FX risks, he's also concerned about USD, thinking whether he should go Singapore or Hong Kong for future DCA. I can answer that quickly, by the way. FX is more of a problem for fixed income investment because you want your capital back. For equities, it balances out. I would always suggest to focus on how you execute the investment approach as well as to identify the right companies more than the FX. He knows his performance is quite good, and although he doubts he can continue with such performance, he is looking for any advice on how to maintain it with less risk. Okay, so now since the question has been posed, let's look at the entire portfolio. As you can see over here, time-weighted returns, we have it mapped against SPY, which is S&P 500, and ES3, which is Straits Times Index. 2020, 20% gain on his portfolio. Very good. Congrats on buying during the crash also. 2021, 40% gains, much better than S&P 500. And maybe because Jay is focused on tech, maybe the comparison should be against QQQ, which is Nasdaq instead. 2022, however, minus 48%. Half of the portfolio gone. And that's versus S&P 500, which is minus 18%. So that reinforces again. When we go with a high beta investing, which means market move 1, you move 3. When markets downturn, it can really bite. But thankfully, in 2023, markets roared 24%, whereas his portfolio grew 59%. 2024, his portfolio again tripled what market return, clocking in 73%, and 2025, 38% versus 7% on S&P 500. So what has driven returns? If you're curious, let's pull up his current investment portfolio. And what we can see is this table seems to be sorted from the smallest position all the way to the biggest. Let's focus on the bottom 5, correct? And they are namely Alphabet with about 40,000 allocated, United Health 40,000, Tesla 46,000, Apple 50,000, and Palantir $71,000. So in total, these 5, it looks to constitute at least 80% of the portfolio, correct? Very concentrated. And in fact, from what we heard just now, United Health was only recently purchased from the sale of Palantir. Which means also, if we backtrack 3 months ago, was Palantir at least 50% of the portfolio? Quite possibly yes, right? So that explains the fantastic performance of 70% in 2024 and 30+% in 2025. The numbers seem very nice, so let's go back to the question. Should Jay sell 50 to 75% of Palantir to buy Google and maybe into Nvidia? So Jay, maybe since you share with us a story, let me share with you some questions I'll be asking. What does this change from Palantir to Google and Nvidia exactly serve? Or rather, we should reframe the question. When would be a time when Palantir would crash? If you think about it, the answer is when the AI bubble bursts, correct? I'm not here to justify that AI is not in a bubble. I would think we are in the very early stage. That's my personal opinion. But if it does burst and Palantir crashes, wouldn't Google crash? Wouldn't Nvidia also crash? Everybody's share price is inflated right now through the AI bubble, and they are also key players in that cycle itself. When we study back at .com crash, we realized even Microsoft, which was a blue chip, generating profits, not like pets.com, they were also seeing a massive drop of 50-60% in share price. So again, the question is, you sell Palantir, you get to another AI stock, it's still roughly the same kind of risk. Then maybe to this point, let's bring up a story of someone who was very famous back 3-4 years ago. She was the founder of ARKK, which is ARK Invest, and she's none other than Cathie Woods. Back then in 2020, Cathie Woods was like God, because her performance was crazy. Everything she sounded, buy this tech, buy that tech, everything that she mentioned went up. And from what I remember, it was even difficult to say anything negative about what she has mentioned positively into social media. And not just that, her own fund's performance, outperforming Nasdaq, outperforming S&P 500, was crazy. Of course, when it results to back what you say, everybody starts to listen, correct? If I'm not wrong, she also sold some Tesla stock to buy other fast-growing tech names. And her entire ARKK portfolio was still focused into tech. But the problem came in 2022. Tech went through a big deflation cycle and everything went south. It highlights also, when you see such a chart, it means a high beta strategy. If markets goes up, the portfolio will go faster up. If market comes down, the portfolio will come faster downwards. And when we look around history, we realize that high beta investors are actually plentiful. When the market is roaring, they look like superstars and then suddenly they fade out of the limelight. And that's why there's this saying, when there's a bull market, everybody is a genius. So learning from that lesson, I have 2 key recommendations to bring up for discussion. Again, this is not financial advice. I just hope to give everybody a bit more thinking points, and maybe you have a portfolio similar to Jay's. So the first recommendation is this: don't go into leverage. Leverage can put a high beta portfolio on further steroids. You can do 5x market performance when you employ leverage even. But when market is correct, that's where panic happens and portfolio can get very quickly destroyed. The second recommendation is actually very simple. If you're in a similar situation as Jay, manage your expectations. That's simple, correct? Managing expectations. And when we understand this whole philosophy of managing expectations, it will lead one investor to make very rational choices. Because if you don't chase returns or hot ideas, you would read and choose investments that may be slow and boring, that may be out of the tech space and have a different dynamic, such as the one in United Health. Not saying United Health is a sure buy now, I'm just saying it's a different dynamic that isn't really fast growth as per all the other tech names in the portfolio. Ultimately, we're not fund managers. We shouldn't be benchmarking too much. We should be buying things we inherently understand and inherently can hold when times are bad. Cathie Woods does not have the luxury that we have, because even if she feels that her portfolio should be de-risked, she cannot. If not, all the investors will run already. So for individual investors, manage your expectations, and you realize you need not always chase outperformance indefinitely, because one day the high beta approach will bite. Looking back at Jay's portfolio, there were 2 key big reasons of why it's done so well. The first is Palantir. The second, on the other hand, lies in this picture over here. What does this say? Capital flow, correct? Which means how much money has been invested into the portfolio. The second big reason of how he has done well is the 30,000 invested in the COVID crash, the 47,000 invested in the interest rate spike crash. These 2 big inflows actually contribute a lot to the success of the portfolio today also. Which means also, Jay, especially with cash flows tightening right now with 2 mouths to feed, your war chest cash becomes even more important than ever. When you're able to moderate your expectations, you realize that you can understand how to be fearful when others are greedy. You can step away from the crowd. Which means also, I would support the idea even of selling 5% of Palantir and keeping extra cash because your portfolio is so high beta already. Chew on it, then go selling 50% of Palantir and buying Nvidia or Google. That war chest cash is one of my first thoughts that I hope you can implement. And if you agree with it, smash the like button. It's taken our team hours to prepare this for you. And as always, leave your comments in the sections below. I'll try to help answer as best as I can for each and every one to become a better investor. Thank you very much. I'll see you in a future video. Check out these also, and I'll see you there. Take care as always. Goodbye.